Hey everyone, Couch Investor back on our video for today. So let's talk about Dollar General. It's down 55% year to date. You've probably heard about Dollar General, especially if you're in the United States. And if not, if you've been following the news on FinTubers channels or on X, well, you know that the latest earnings report hasn't been great. And since then, the stock has continued to go down week after week. And that's why the chart looks something like this. We're now back at prices not seen since, well, around the end of 2018. Now, while currently the stock is really in no man's land, it's very much oversold. MACD is extremely bearish. Maybe, again, the magical number, the $100, might serve as a support line. Now, what has happened before? Well, it's not just this more recent earnings report that was bad. Well, back in May, that was already a sign of things to come. Because if we go back to that earnings report, net sales increased 6.8%, same-store sales increased just 1.6%, but here it comes. Operating profit decreased 0.7%, diluted earnings per share decreased 2.9%. By the way, this is a dividend-paying company, just so you know. So they already told us something here. While the macroeconomic environment has been more challenging than expected, particularly for our core customer, we are confident in Dollar General's ability to deliver strong growth in the years ahead, despite the near-term pressure which impacted our first quarter sales results and is anticipated to impact our full-year sales and EPS. Now, who are those core customers? Well, there was a report here in March that says that the typical Dollar General customer is an older rural worker with a high school education and an income of less than $40,000. In short, Dollar General has just over 19,000 stores across the United States and Mexico and employs more than 136,000 people. 40%, well, roughly 40% of US shoppers are Dollar General customers, making an average of 32 visits per year. And Dollar General's average customer is older, has a high school diploma, and earns less than $40,000 per year. Which, if you compare it to the others, you can see the big difference here. Walmart, $80,000, Costco, $125,000, Target, $80,000, Whole Foods, same, and the same goes for Amazon as well. Of course, different types of business models across all those companies. But specifically Dollar General, when times are tough and you are a household of just, well, earning $40,000, then maybe you start to think twice about how much you're going to spend, when you're going to spend, what you're going to buy, etc., which could not be said with the other companies when you're basically earning double that or even more. And so right now, that's maybe one of the things you're seeing with Dollar General. That's why that's impacting the business a bit more, because in the last couple of years, with free money flowing into the economy, yes, Dollar General was a company that benefited from that, but now high interest rates, tough economic environment, well, people are thinking twice before they spend their money, which is why we had this quarter here. Net sales increased just 3.9%. Same-store sales decreased 0.1%. Operating profit decreased 24.2%. Diluted earnings per share decreased 28.5%. I mean, it's not a pretty picture. They're still paying out that dividend. They are saying here, while we are not satisfied with our overall financial results, we made significant progress in the second quarter, improving execution in our supply chain and our stores, as well as reducing our inventory growth rate and further strengthening our price position. We are pleased with the advancements we have made, and we are now taking further actions and making additional investments to accelerate our progress and ultimately serve our customers even better, which is something that probably they should have done when the company peaked in the last 2 years. While these investments will pressure our 2023 results, we believe they will further strengthen our foundation as we move into 2024 and focus on driving sustainable growth and creating long-term shareholder value. More on that long-term shareholder value in just a bit. If you wanted to know where the sales are coming from, you can see consumables that increased 6% year over year, seasonal decreased 1%, home products decreased 7.7%, apparel 7.1%, and so net sales increased just 3.9%. Now, if you enjoyed this video so far, please leave it a thumbs up, subscribe if you have not. We're trying to reach 30,000 subscribers by the end of the month, so thank you very much. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Now, talking about the shareholder value, as you can see in the last 10 years, shares outstanding is down 32%, still paying a 2.18% dividend yield, has a forward PE of 13.7 times. More on those comparisons a bit later, but here you can see how they create shareholder value, maybe how they created shareholder value in the past. I mean, if you bought 10 years ago, of course, now this year, your profits are down 55% or unrealized gains down 55% year to date, but your shares are more valuable now than 10 years ago. What we can also see here is that, well, 2021 basically free cash flow per share peaked and then it goes down from there. If we go and look at price to earnings, EV to EBITDA, price to sales, price to free cash flow, today compared to the last 10 years, there is a clear trend here. Right now, the shares are much cheaper than its mean. So if you look at PE, currently 13.7 times in the next 12 months, compared to 18.6 times. Then if you look at EV to EBITDA, 12.3 times right now compared to 12.8. Price to sales, 0.6 times compared to 1.2. And then that's the only one that is more expensive right now. I mean, that's obvious, seeing how right now profits are down, but expenses are going up. So price to free cash flow, 253.8 times compared to the mean of the last 10 years, 40.6 times. Do with that what you want, but currently, although yes, currently the situation for this company isn't that great. I mean, if you're looking to buy a good company with a good track record, something that I don't think will go away anytime soon, then yes, currently you will be buying it cheaper than its mean in the last 10 years. That said, it could definitely go lower if things don't improve in the short term. So what are you doing currently? Do you hold this company? Are you maybe planning on buying for dividend play, maybe dividend plus growth? Let me know down in the comments below. And as always, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.